Kokkie Kooyman is with Denker Capital and our go-to man on financial services, of which there's been a lot of news lately, including today with the results coming out from the Outsurance group. Who would have thought? Started in 1998, this company is now generating 4 billion rand a year in profit and moving into Ireland as well as Australia and, of course, strong here in South Africa. But that's only a very small part of our conversation today. Kokkie, lovely to be talking to you between meetings. Were you at the Outsurance results?
I was at the FirstRand management meeting discussing their results. I just saw the Outsurance results come through. Very good results, but it's an exceptional company. We can talk a bit about that as well.
Well, maybe we should start with an overall picture. When I look at FirstRand's 5-year share price, hasn't gone very much. 28% in 5 years. You're probably not even beating inflation at that kind of level. Does that mean that it's building up momentum maybe for a bit of a surge?
Yes, Alec. Life is always so complicated. You ask the right question. Firstly, bear in mind that 2019, before COVID started, and that's more or less 5 years ago, was a very good year, and the market was strong, and bank share prices were running, so they got a bit too expensive at that stage. So we've seen a de-rating of all bank shares, in fact, with the exception of Capitec, and in fact Investec. Well, that's been a different story, but generally the SA big banks have de-rated, and also because of the provisions needed for the COVID era for suddenly when Russia invaded Ukraine, and food prices and fuel prices started rising, the rand fell. So there have been a lot of things that ensured or caused low profit growth and low net asset value per share growth. In other words, the bank's stability were under pressure. And that's really why you've seen this sideways move. Okay, so if we go forward now, in banks like Absa and Nedbank and even Standard Bank are still very mispriced. The FirstRand is not so mispriced anymore, but it has the highest best prospects in terms of high return on shareholder value. And say our FirstRand isn't, I think it will also, all the banks will do well in a falling interest rate environment with growth coming. But the big trick now is going to be what to select. Do you go for the really cheap ones that potentially have problems or small, or do you go for the ones that are really a bit expensive but will re-rate a bit?
Even if I go back now to 2017, so that's 7 years ago,
Yes.
FirstRand's share price was about the same level that it's at now. So I hear what you say about it having maybe been overrated ahead of COVID. But isn't it now time, when you work that back, to say it's a much bigger company, much bigger balance sheet, and you've now just had the insight of engaging with a management team today? So, and I'm concentrating on FirstRand because it's worth 460 billion rand. It's our biggest individual, a bank or financial services company. Yeah. It seems cheap with a 5% dividend yield, better than they pay you on their savings account. So, is it not one that even conservative investors could be looking at?
Yeah. Look, maybe just one thing to bear in mind when you look at the share price return, especially in the last 2 years, one must bear in mind the dividend payments as well. And the banks have been on very good dividends. You've had, on average, most probably over those 5, 6, 7 years, most probably had a dividend yield of, let's say, 5% average. Initially, it wasn't that high, and under COVID, they first had to hold back. But then post-COVID, the dividend yields got as high as 6, 7%. So you had very good dividend yields. You must add that back. Let's say a 5% dividend each year over 7 years, that's 35%, and then plus the re-rating. But you are right. I mean, FirstRand is a great bank, very well positioned. The UK problems have also been overcome as provision for in terms of the investigation into a commission problem there, not for them, but with the industry. And so FirstRand will grow shareholder value at, let's say, 20-25% per annum. That's already quite good, even if it doesn't re-rate. So you should do 25% out of FirstRand. Some of it you get as a divvy, and then you still get a re-rating. And you know that you're with a quality bank. You're unlikely to open the newspaper and say, oh, here's something negative about FirstRand.
50,000 employees and a new chief executive. What do you think of her?
Good. It's a tough job. I asked her this morning, Mary, and I met Alan Porringer, the previous CEO, and yes, it looks like he's lost a few years. He suddenly looks so much younger. I realize it's the stress. We forget the stress of being the CEO of a large organization, and with so many people that you are responsible for, and you've got so many different stakeholders who all put pressure on you, and you've got to make the decisions. Sure, you're surrounded by a good team, but no, she's learned quickly. What I like about Mary is, well, she'll always defer. If there are fellow executives in the room, she'll always defer and say, Marcus or Andres, or what do you think? You get CEOs who always have all the answers, and to me, sometimes a dangerous sign. And so, but FirstRand, I think, stand out on having a very, very good team and what we call very good reserve bench as well.
Mary Vilakazi, the half of a power couple of Joburg, with her husband being the Dean of Wits. So you've got a heck of a CEO in there in Mary. You've told us now all about FirstRand. We understand the future, but it wasn't long ago that Outsurance was created by FirstRand and has now been spun off. And today it released its financial results, which appear on the face of it to be very strong. I'm sure you haven't had a chance to go through them in much detail, running around as you are, but this as a company, as an insurance business worth investing in, given that they have moved aggressively into Australia and now even moving into Ireland, looks like Outsurance is another one of those FirstRand success stories. And of course, we recall some Discovery.
It's interesting as an investment team, we often, that is the big debate, because investments over time, I mean, Warren Buffett is well known for saying that you've got to get a few things right, but two of them are very crucial. You've got to buy quality companies, you back the management and you back the franchise, but preferably you do that when the valuation, when the share price is below what we call the intrinsic value. That's a different debate, but you want to get it at a good valuation. And if you do that consistently, you do well over the years. And every now and then you get a company like Outsurance. Capitec is a very good example. You got one in Brazil now, Nubank, and so one actually just recently launched in India, Bajaj Home Finance. They have this exceptional management team that are just innovative, that come with a fresh business model, with fresh technology, and are just taking market share. Well, Capitec was slightly different. It didn't have at that stage, it didn't have that fresh technology, but they were fresh in attacking the opposition. So with Outsurance, what you're really doing, because it is expensive already relative to, let's say, a Momentum or an Old Mutual, you're saying, do I back this management team to continue growing market share? And in this case, I would, and we are in our own funds, because they've demonstrated the ability to just be innovative, be quicker than the competition, just a whole advertising campaign. A big problem with large players is they find it very difficult to fight against themselves, because often your own business has wide margins in the products you sell. And you don't want to go and cut those profits and give more to consumers. It's a very brave move, but it's the right move. Along comes somebody like Capitec, early years, now Outsurance, and just cuts away by cutting the price that consumers can do business with them. So with Outsurance, done very well. Australia was a bit of a problem initially, and still every now and then. But Ireland the market was a bit hesitant about Ireland, and still is. It's a new market. It's always tough to go into a new market with a new regulator. But the reason why they chose Ireland is because it's a very fragmented market. It means that you either want to go, Yanni Matun was very good at saying that, you either want to go into a market where there are few big lazy players, and you can just attack them because or you want to go to a market where it's very fragmented, nobody's strong, and you can just steal market share from everybody because nobody's big enough to react to you. And Outsurance is one of those. So that's also one, definitely, you can put in your portfolio, and every 3-5 years, or maybe every year, you look back and say, oh, that was a good decision.
very strong results coming through to support Kokkie's view of that. You mentioned Capitec a few times. We've got the results from Capitec coming out in a couple of weeks' time. Are they once again going to surprise on the upside?
Well, it's going to be difficult now because they already had to do a pre-release where the expectations were raised, and then later they updated that pre-release saying, well, it's actually going even better than we thought. And look what's happening with them. They stood back when the consumer was under pressure and tightened their credit criteria. So it looks like their provisions were too high that they made for potential bad debts and did better, especially on the insurance side. There are quite a few things, new initiatives that they've started. That the small business, they just continue to take more market share than they expected and continue to do so. So the problem with Capitec, if you look at it on a global banking scale, in fact, I think at the moment there are only like 3 banks that are more expensive. One is Nubank, as I mentioned, and that's sort of a relatively new player. And I think there's one in Kazakhstan, Kaspi, a bit like Tinkoff used to be, very innovative, Kazakhstan of all places. And so you look at it and you say, can I defend this valuation? We've done the work, and every time if you go back over time and you bought it when it was this expensive, after 3 years, you always still do well because of that high return on capital. Their return on capital is about 25%. Remember, that compounds 25%, 25, whereas let's say Absa is backing to do 15 at the stage. There's a 10% differential in your shareholder value growth. You've got something like ABN AMRO in Holland that's backing to get to 10 or 9. So 25% return on shareholder value is very good. And you keep plowing that back into your business. And that's what Capitec is doing. And now, very few people know that, but they increased the holding in Everson, something they've held for a long time, very low, a small holding in Eastern Europe. Generally, and just been watching, and suddenly they stepped in and bought out everything except, I think, a 2.5% stake, which managers will have. And that could be in 3, 5, 10 years' time, another growth area if they just replicate the model they've done here. So Capitec has got a lot of things going forward at the moment. It seems expensive, but a quality company like that always seems expensive.
That's such an interesting point that you make there about Capitec even moving into Eastern Europe, because the other big company that released results today is HighProp, a property company, and it says it's investing, although it's got a lot of work to do to stabilize itself, I guess, with high interest rates hurting the company, but it's investing in its preferred, or what it calls favored jurisdictions, the Western Cape in South Africa and Eastern Europe. What is it about Eastern Europe that South Africans love so much?
Yeah, it's the world. Well, I wouldn't say the world lived it, but they've certainly demonstrated that the big advantage in Eastern Europe is that your labor cost is lower and then also your tax rate is lower. So that obviously makes it attractive. And by the way, investing for a South African company or any company to invest outside of your own borders brings a lot of risk. There's a lot of new understandings, and you're up against players are there. So you've got to make very sure that you really are better and can grow market share and can do so. And often you have the local regulator being against foreign competition. But Eastern Europe is I think the one thing Eastern European countries have realized, if we want to bring unemployment down, which in the 2000s, 2003s was still very high, if you want to bring unemployment down and create growth and wealth for our society, we've got to bring in foreign capital and foreign expertise, and which they did, and that's really helped grow the economy. And so they continue doing that with tax rate that's lower than the rest of Europe, although that's changed a bit now with especially banking taxes. But generally, it's a higher growth environment. So Czech Republic most probably still grows, I think, at 3.5%, which, let's say, Germany, France are technically just starting to get to 0.5% real growth. And so it's faster growing countries.
Well, that's a ballpoint then for HighProp. But what about it as an investment proposition, given that it is going to be a beneficiary from a reduction in interest rates? Is this something that you see in all property companies?
Yes, interesting. It's a very good point, and I don't focus so much on the property companies. I've got enough just trying to keep up to date with banks and insurers and exchanges, but property companies also in the financial sector, and they definitely benefit from lower interest rates. Again, also because credit demand and growth picks up, and I've noticed a few of the property companies in the results started saying that suddenly vacancy levels are dropping very sharply. That goes straight to the bottom line of a good company when your vacancy levels start falling. And so growth is always good for property companies as well, especially because property companies post-COVID have come off such a low base. Those were mostly the 3-5 hardest years where you had work from home, you had higher unemployment, so on. All those trends are starting to reverse. Almost every large company I read about is starting to dictate to employees work from home is over. Yeah, you've got to come back to the office. We want you here. And that obviously is good for your property occupancies. Also from the point of view, just imagine a large organization, JP Morgan. JP Morgan has, let's say 5,000 people that work at its head office in New York. It's only 1,000 coming in, now 5,000. Suddenly all the coffee shops in the surrounding area, all the pizza places, they all start doing better. It shifted away from the small and local areas where people live, the suburbs. But the property company are generally in your bigger centers and generally do well and will do well, I think, in the current environment.
Well, HighProp is 40% higher this year and up by 3% on the results today. Two of the points that its management made in the results was they're taking a lot of positivity from the Government of National Unity and the electricity situation where we've now had more than 170 days of load shedding. Kokkie, we had today, just to close off our conversation, the release from the BRRMB Consumer Confidence Index, and that's gone from -10 to -5. So it's still below the long-term average of 0. But the academics tell us that it's at the best level, and this is for the third quarter of the year, best level since the first half of 2019. So kind of a 5-year best that we're seeing. It seems as though, well, first of all, is this justified?
Absolutely. And I'm not surprised that it's so minus because there's still a lot of uncertainty about the GNU. Even last week was rocky again with some of the acts that still wants to pass and the partners don't want to pass. But if we can get the politicians to accept that creating growth will enhance the possibility of winning the next election, and it will go for all especially the main parties in the GNU. And that's the right thing to do. You want to create growth. And as that growth comes through and the right policies are being followed, I think your business confidence will definitely rise again. On the electricity front, load shedding, just bear in mind, partly it's because the economy wasn't running at full speed. As the economy picks up, it's going to be interesting to see if we start hitting capacity constraints, especially on the mining side, if they really start operating at full productivity again. But then also we've had another solar installed. It's basically one Madupi that's been installed. So it's going to be interesting. The bottom line is, I think, I would say next year, even towards the end of this year, if we keep going this way and the government doesn't make mistakes now, then your confidence levels is going to increase. You're going to get foreign investors, and they're already queuing up to start having meetings with our banks. Just heard that this morning as well. Before the election, they didn't know there wasn't any interest in meetings with South African management, and that's starting to happen again. So you're going to start seeing foreign investors coming back. They're not really back investing in South Africa yet. So as that comes, the market could still have a very good year.
Good point on which to end our conversation with Kokkie Kooyman from Denker Capital. I'm Alec Hogg from biznews.com.